Welcome to Friday Takeaway. We go on the road this week with UMW and Tan Chong, but hey, it's a brand new month, so let's kick it off with... I think markets must be glad that the month is over because markets in Asia actually advanced on Thursday, emerging from what was the worst month in more than 6 years. Hong Kong and China saw their stocks overperform, and in China, the government indicated that further stimulus measures could be coming. Now, over in Europe, UK and constant frenemy, the EU seem to have agreed on a deal that would give the UK financial services companies continued access to European markets once Brexit has taken place. With only 5 months left on the clock, a lot of British businesses are demanding certainty in their trade terms. Now, the KLCI didn't really keep up though because of the budget which took place today, hence the premature jitters. But hey, it happens to everyone, right? The real full effects, of course, will be felt next week for sure. The ringgit, though, didn't fare very well. It was near its weakest levels because there's a lot of pent-up worry about the budget and the government's tactics for dealing with the fiscal deficit. Budget aside, this week we saw 4 Bank Negara officers involved in the January land deal worth 2 billion ringgit going on leave as the central bank had commissioned a review in August to look over the deal. PM Tun M says that obviously somebody in Bank Negara obviously knows what happened to the proceeds. The allegation is that some of the money went from the deal to settle 1MDB's debts. Finally, a couple of earnings. Bursa Malaysia itself posted 3Q numbers where it saw earnings improve by 2.6% to just over 172 million ringgit due to higher operating revenue, which is good when you consider how rocky the markets have been. Heineken Malaysia's 3Q was also very solid, up almost 20% to just a touch under 79 million, and that was due to stockpiling both ahead of the SST and the budget and also improved consumer sentiment. This week, we get into the driver's seat with 2 auto companies, UMW Holdings and Chong Motors. So on Wednesday, UMW announced that it would be giving up its quest for the 50.07% stake in MBM Resources, as well as its pursuit for Perodua, which brings up the question of what's next. Chong Motors has been laying low, but 2018 actually saw the company come back from being in the red last year. But can it keep it up as industry TIV remains tepid? Let's set off. UMW is one of the largest industrial companies listed in the bourse with 3 core pillars of automotive, equipment, manufacturing and engineering. It is their automotive biz though that we are interested this week, and UMW is the distributor for Toyota and Lexus, and one of its associate companies is Perodua. It was the end to what was a very messy battle for what essentially was control over national car maker Perodua. UMW said that it had allowed the agreement to lapse and will not further extend the period for the corporate exercises it was going to do for it. How it intended to do it was through a purchase of a 50.07% stake in MBM Resources, which holds 22.58% in Perodua. Are you following me so far? Alright, so this didn't sit well with MBM shareholder Med Bhumika Mara, which actually objected to UMW's intention to engage with their key principles, saying it might actually confuse or mislead them. There was a slight knee-jerk reaction to UMW, which has, however, been on a bit of a downtrend anyway since the beginning of the year, but it seems that the news didn't really cause the price to fall off a cliff. Because in a way, UMW now has that monkey off its back and it can recalibrate its corporate strategy and focus on improving its financial performance, which is what Group CEO Badrul Faisal Abdul Rahim says. It will also keep expanding into high-value manufacturing as it attempts to remain resilient. Now, MIDF also says that it expects Toyota's market share to hit a major inflection point in FY19 as UMW's new Bukit Raja plant comes on stream in the first quarter of next year. It expects Toyota's total industry volume to actually increase 13% year-on-year and market share to expand to almost 14%. After the deal fell through though, a few analysts actually upgraded their calls on UMW, such as Hong Leong IB, but it actually reduced its target price to 5.35 as MIDF did as well, from 7.11 to 6.50 ringgit. HLIB says that the new Toyota Vios and Yaris would actually help to fill the gaps in UMW Toyota's model mix, and the current sales volume is very encouraging. But it is a little wary over that new plant as the teething startup cost may offset any efficiency savings. Chong Motor is a multinational automobile company, but hey, best known as the franchise holder for Nissan. Other than that, it's also the distributor for Renault and UD Trucks and Silverbus brands, and it also has businesses overseas in likes of Vietnam and Myanmar. All in all, it's been a pretty good year for Tan Chong, with its latest set of results showing a really strong comeback compared to last year when it was in the red. For the first half of the year, it actually managed to clock in 16.6 million in profit compared to last year where the loss was 58 million. And this is despite the ever slightest of slight drops in top line. So AM Invest actually points out that for Tan Chong, its margins and dividends are now priorities rather than whole volume. So it's switched away from that into more niche opportunities. TCM also announced that the new Nissan Serena S Hybrid actually reached a milestone of 5,500 bookings, and of that, 4,000 units have been delivered as at October 30th, which means 73% fulfillment of bookings. It is still keeping a bit tight-lipped though on new launches to come. Tan Chong's overseas ops still ain't great, and in Vietnam is still in the red, and its other Indochina markets like Laos, Cambodia and Myanmar is still really tiny. In Vietnam, its Da Nang plant suffers from low utilization and government regulation. So, Tan Chong is considering more CKD models and using the plant for contract manufacturing. Also, overall, the Malaysian Automotive Association is only expecting really tepid growth of around 2% for 2018 as people calm down from the tax holiday and spending adjusts. According to Bloomberg data of the latest analyst calls, it's almost even between buy and hold, with 4 research houses calling buy, while 3 are in the neutral camp. Taking that into account, the share price target ranges from 2 ringgit 30 on the top end to 1 ringgit 75 on the bottom. Taking a look at the share price, it's been just over 140 over the past couple of weeks, but down from where it was in September, where it was around 170. On average though, the counter has been trading at 1 ringgit 30 over the past 52 weeks.